Hope everyone is doing well. Wanted to give a brief discussion over always in for just a quick second. It's really important to understand. And always in really comes down to understanding, and this is the fundamental piece between trend and a trading range, binary decisions. Always in is really great for a trending day. The reason for that is, if you look at yesterday, the major move is down. There's no real minor moves. I mean, this is minor, minor here. It's clearly going down. As opposed to yesterday, there is no clear, as opposed to the 27th, there is no clear always in direction or major direction. We had a bear breakout and two legs down or a couple legs down, but it's within this bull rally. So move up, move down. It's minor. Minor implies you can't have two major directions. I consider something major to be, keep it simple. You can say that, sure, this is a major surprise bar or a major move, this is, and that if we rally back up, the market's going to be a trading range. But you should use that as a tool to understand better what to do. So let's look at a few examples of that. Like right here. This is a pretty major reversal up. So the market's going to be a bull trend or trading range. So looking to buy is going to be way more effective than looking to sell. Strong breakout, same thing. The market's probably going to be in a bull trend or a trading range. This sell-off, is this a major sell-off? Well, not really. It's going to be more of you're going to get a couple legs down like this, maybe one less push down and then a reversal up, and the market's going to go back up here, and then you're going to rally. But at this point, you've had to move up, move down, move back up. You're probably in a trading range. So, well, this rally slightly increases the probability of more up. It's more likely, it might be more likely to break to the upside. It's trading range. So if you're looking at this open, what's the major direction? Well, kind of expand the chart like this. It's hard to say what the major direction is. So if I'm looking at the first bar of the day, we're in the middle. Is it always in short, always in long? I don't know. It may go down for a few legs and reverse up. So it's more of a trading range. So traders are going to start fading. Big bull bar. Well, what's the always in direction? I don't know. Therefore, there's nothing very clear. The bulls it's really breakout mode. So until we get something that's clear, this is good, but it's not dominating like this. And then we get this. Okay. This looks a little different. That this has the potential to lead to something strong. Maybe a second leg down, but it's still within this range. Reversal, possible second leg, but this is still stronger, so better to look to sell. Big bear breakout, testing the bottom of the range, strong enough breakout that we may have another leg down. It's probably always in short, but bottom of a trading range. So traders are going to be willing to exit if there's a big bull bar, or exit if there's some sort of micro double bottom. Tail, bigger tail. So some traders might exit, but this is still strong enough that the first reversal up is probably going to fail, especially with that tail. Now we have three bear bars. And, the point of bringing that up is always in can give you an idea of the direction one should be in. And the more it looks like a trading range, the faster people are to exit. And the faster they are to anticipate failure or disappointment. So if you're long here, and then you see this tail, and then you see more tails, bear bar. what are you going to do up here? Well, you should be thinking trading range, therefore you should anticipate disappointment and look to exit along. Well, if you could think through that, then it might make sense to start selling, looking for a failure. The opposite is this day. 3 big bear bars, first reversal up's going to fail, so just stay short. More bear bars, very strong sell-off. Is this going to reverse the market? No. Is this going to reverse the market? No. The bulls are going to have to go sideways for several bars. So there's really, if you can use the stop up here, there's really no reason to get out unless you're getting out of shorts and looking to sell higher. So maybe you get out, look to sell up here, or then you get a bull bar and then bear bar, you look to sell again. Now, if you hold on a day like today, a day like yesterday, the 27th, you're going to have way more profit. This is the 28th. You're going to have way more profit potential staying short. But most days, on a trend from the open, they go sideways. So, trend from the open, sideways. So, you're better off taking profits. But let me tie that into today, which is what I really want to talk about. And if I was trading always in, there's a couple of things. On the open, I'd be expecting a trading range after yesterday's consecutive sell climaxes. So I don't want to sell down here. I'm looking to buy. We have a sell-off, pause bar, second leg down, reversal up. It's a reasonable buy. Then we break to the upside, and when you break above a major lower high, the market's either in a bull trend or a trading range. It's more likely in a trading range. So if that's the case, you want to look to take profits up here. I'm expecting disappointment. So when you get a big bull bar and then you get a disappointing follow-through bar, another big bull bar, disappointing follow-through bars, it's the same thing that's happening on the daily chart here. You have a breakout bar, but this is the always in short. It's down. We're reversing up, and traders are disappointed. And until the market even if the market gets up here, it's probably going to be a trading range. Let me go back to the 5-minute chart. So, to summarize the whole point of bringing this up, always in's great, but you have to understand one trades differently in a trading range than they do in a trend. And in a trend, you want to focus on the major direction. You always want to focus on what the major direction is. But on days like today, the major direction is not that helpful. It's been going down, but once you get a big move down and big move up, you expect sideways. So any sort of rally may have a couple legs up, fail and reverse. Big bear bar, but again, it's in the bottom of the range, might be a 50% pullback of this. Traders will expect it to reverse. If you buy here, you get a rally, but tail, disappointment here. Another bull bar. Traders should exit here. Consecutive bear bars might be always in short, but could be early. We may fail down here. So you get a disappointing bar or disappointment and then a second leg down. So traders are quicker to exit on disappointment in a trading range than in a trend. So I'll cover that more in a minute, but again, always it's going to be more effective to use limit orders and scalp in a trading range, but that's difficult to do. So the next best thing is an always in kind of approach. And so on the open, I'll just do it like this. First bar of the day, as I said, it's another sell climax. This is probably going to be a final flag. I'm expecting a trading range day. Well, I don't want to buy yet. I don't want to sell either. But it is always in short. So if a trader was short, which they probably shouldn't be, if they were, they'd be disappointed here. It'd be smart to get out. Then you get an outside up bar. Not closing on its high, but we could easily 50-50 chance this first reversal fails and the market reverses up and test up here. Big bull bar, but again, probably a trading range after yesterday. So your stop's theoretically down here. That's a big risk in a trading range day. Traders will scalp. Disappointment bar, reminder that the market's in a trading range. So traders that were long, bought this close, then maybe they bought more lower, they're going to look to get out somewhere up here. And outside up bar, but tail, bad high one. Bears probably will make money. Second entry short. The market went up, turned back down. Traders will sell or sell below this bar, stop up here. Betting that the bears become disappointed. Maybe the market tests the breakout point down here, which it did, and it even went all the way down here. Possible two-legged pullback, but 3 consecutive bear bars. Is it always in long, always in short? Hard to tell. If it's hard to tell, traders are quick to exit and they expect scalping or trading range mentality. Rally, but bad follow through. And again, it's traders will buy this close, they'll sell this high, they'll buy this low. Really hard to do though. They'll sell up here, wait for a few bear bars, maybe sell this close, stop up there. Disappointment here, forming a triangle. It might be always in short based on these bear bars, but hard to tell. Might still always be always in long here. Strong enough breakout and may get a second leg. 3 consecutive bear bars, but tail disappointing at this low. The market could easily reverse up here. So what are traders going to do? If they can anticipate it, traders would exit shorts down here and look to buy. Consecutive bull bars. Disappointing up here. Tight channel. First reversal up's probably going to fail. What should traders do up here? Well, probably look to exit shorts, anticipating disappointment, and the bears that sold are going to make money, which they did. Now you have a high one buy, bigger bull bar, but again, it's a triangle. So at this point, it's better to assume that everything's going to fail until it doesn't. Low one short or low two short, low one, low two, consecutive doji bars. What's the probability we race to the upside? Isn't that a bad looking low two? Well, maybe, but it's also a trading range. Trading ranges go further than you want. So while I do think this low two may fail, we could easily fail down here. Big bear bar. Is it sell to close? Maybe, but it's low in the range. So if you're selling down here, that's hard to make. You know, it's okay if you can make really quick decisions, but it's not the most ideal trade in the world. And then disappointing bar, doji or bull bar, closing at its midpoint. But a lot of bear bars down. First up's probably going to fail, may get a second leg. Then we went outside down. So now you have 3 pushes down. 1, 2, 3. Maybe a break below a wedge. But again, testing the low close. Is it always in short? Maybe. It might be always in short, barely. But if you get a bull bar closing above its midpoint, that may reverse it back to always in long. You know, in theory, it's always in long from this 2 consecutive bull bars. And then we get a bull bar, and then a big bull bar. So this is the exact problem with swing trading in a trading range. You sell, you get the second leg. It's strong enough to stay short. You're hopeful that you'll get a bear breakout. And then you get this doji bar and you think, gee, I don't know. You know, it's a second entry buy, it's a wedge bottom, 2 legs down. It could be a double bottom with this low. Al always says that most stop entries in general have at least a 40% chance, worst case, of working. Therefore, it's probably smart to get out and look to sell higher. And that's exactly what happened there. And then you get this weak follow through bar. But again, it goes outside down. So what's going to happen here? Is this going to be a double top that leads to a measured move down, or are you going to get a second leg up? Well, you're probably going to get a second leg up. Low two short, again, probably going to get a second leg up, low in the range. But we could easily have a really deep pullback. So it's difficult to buy here, stay short, hold below this, and then you get that. It's what happens in a trading range. Well, trading ranges are notorious for trapping you out of the market, and often it will trap you into buying some sort of second entry at the top, second entry buy, and selling some sort of second entry short at the bottom. Now, you don't have to short the second entry for it to disappoint you and affect you. One could simply sell below a low 2 short. They could sell out of longs, and then you get this big bull bar. So now you're faced with, well, darn, do I chase the market up? Maybe. But again, it's middle of a trading range, breaking above all these bars, breaking back above the moving average. It could be a lower high with here. And then you get this big outside down bar. So, moral of the whole point, if I could stop right here, one thing I would say is it's really easy to get hopeful in a trading range. And this is why people gravitate to limit orders and scalping, because they realize that if they buy too high, or if they buy on hope of a breakout, they can easily get trapped. So the disappointing thing here is traders buy, they get stopped out here, they can't, and then they short, only to watch the market reverse back up. Instead, traders should be buying pullbacks and selling out of longs on the rallies. And the other problem with right here that I wanted to mention was stop placement, which is another reason why trading ranges are difficult. So here is basically, let me do this. Here is the range, and maybe it's something like that. Middle of the range, somewhere here's the top, here's the bottom, somewhere in the middle. If you're buying here, where's your stop? Do you put it here? Or do you put it at the low of the day? Well, the low of the day gives you higher probability, but it also gives you greater risk, which now puts you all the way up to here. It's an okay trade for a swing, but it's not ideal. It's probably better to look to buy a pullback, which is why that happened. Outside down bar, but bad follow through. Same thing. Not ideal to sell down here and put a stop up here, betting on a target here, because that requires a successful breakout of the range. Bull bar, bad follow through. Trader sell, disappointed, get out break even. Other bulls try and buy a 50% pullback, betting on a second leg, which they got. Breakout follow through, disappointment bar, but it's a micro channel. It's probably always in long. I don't think we ever really win always in short after this rally. Maybe we did here, but again, trading range. Breaking the upside, big breakout bar, but best looking bull bar, high in a trading range. Probably, again, where's your stop? If you buy here, what's the probability the market goes here before it goes down there? Well, it could easily fail up here. Trading ranges are notorious for making one hopeful that the market's going to go higher. Second entry short, doesn't look that great, but trading range day, consecutive buy climax is here, here, here. Reasonable to take profits and look to buy lower. 4 consecutive bear bars, and then we got a second, so this was a pullback, trying to break below. Follow through bar, big bear bar. It might be sell to close here, probably is, but again, traders will probably be disappointed quickly. But the odds favor second leg down. That's your second leg. So if a trader was short here, as the market turns up, they're probably better off being quick to get out, because the market could easily reverse back up and this be a second leg trap. It happens all the time. Bear breakout, second leg, reversed up. Bear breakout, pause, second leg down. Bull breakout, pause, second leg up. And then a deeper pullback, which led to 2 legs up and reversal. So bull bar, hesitation, and possible wedge, 1, 2, 3, but bad looking signal bar, inside bar, broke to the upside. Are we going to break to the upside here? Well, maybe, but again, try it here, try it again, trying another time. You may find bulls that were disappointed that bought the close look to take profits, which they did here. So, overall with this day, it's important you can swing trade this day, but your one's a lot better off if they can anticipate and understand where the sell zone is disappointed. I think the audio cut out for a second, but understand when the traders are going to be disappointed. So if someone's looking to trade, if they can understand where the swing traders will be disappointed, they can. It's a 3-step process. So if I'm short, I'm disappointed, and then I see this doji, and then I see this bull bar, and I say, darn, I've got to get out probably. And then I see this rally, and then I see the second leg, and maybe I sell again, and then I see this bear bar follow through, and then I see this. Well, and I'm thinking, dang, I've got to buy back shorts. Well, if I can understand what's going on, one can get in and out quicker. What do I mean by that? Well, go back to this. If you notice this sell-off, and then this hesitation, and then the second leg, and if you notice that this breakout closes as it breaks below, but closes at the low, maybe slightly below, but has a big tail, doesn't it make more sense to just buy back the short from the beginning? Sure. Take that a step further. What if you weren't short, and then you see this and you say, bulls may give up here. It might make sense to just buy at the market, betting that price reverses up. Or if over here, bears are short, they'll be disappointed here. They may give the market one leg down, but then when it reverses up, they may give up. Well, one can buy expecting those always in or swing traders to give up above this bar and anticipate it. You anticipate scalps, though, by understanding the always in direction and what swing traders are doing. So I hope this video helps.